All right, so I'm going to keep my fingers crossed that the audio works on this one, and we're going to answer each of these questions. So, first question. A lender will make an 80% loan-to-value loan on a property that is appraised for $72,500 and sells for $73,500. If the buyer has saved $14,450 for a down payment, how much more, if any, will he need in order to make the down payment required under the terms of this loan? So, two things to always start off with math questions. What are they asking, and what do we know based on the question and what they gave us? What are they asking? How much money does he need to come up with in order to buy this place? What does he need to put down now that the terms have changed? So to figure that out, first we should see, why do banks use appraisals? And the answer is to confirm the value of the property. The bank wants to make sure they're lending the right amount. If a place appraises for less than the contract is agreed upon, that is going to be a problem, potentially. So there are a couple options that could happen. First, and what happens in this situation, the buyer can come up with the cash to pay the difference. Another option, the deal could end up dying if there's a mortgage contingency in the contract that says if the property doesn't appraise or if the buyer can't get financing for the agreed upon amount, they're allowed out of the deal without any penalty. That would be a mortgage contingency, number two option. Final option, the buyer and seller could negotiate. The buyer could say, hey, I don't have any more cash to put down, and I need you, the seller, to come up with the balance so we can make this work. Or they could go back and forth, figure out what to do. The seller could reduce the price, pretty much waiving the additional money, or they could work it out, each pay half, whatever. So those are the three options. The answer from this one comes from paying the difference, and it's a little bit sneaky like a lot of these math questions are, so let's keep going. So in this question, the bank is saying, we don't think it's worth $73,500, we think it's worth $72,500. That's the value that the loan is going to use, because that's the max the bank says it's worth. So everything else now, we know we have to base off of the bank's appraisal value. What do we know? It appraised for less than the sale price. The buyer has $14,450 down, and the bank will lend 80% of their opinion of the value. That amount, $72,250. The sale price is $73,500. So those are all of our known facts. Now we can break it down and figure out what's going on. Just restating what they're asking here. And we know the buyer has $14,450 to put down. The bank will lend 80% of their appraised value. So we have to do a little math on that. Take the appraised amount by 80%. That's going to give us the loan amount, $57,800. Remember, that's based off of the appraised value, not the price. So now we need to figure out how much is the down payment. To do that, we take the value of the loan. So we take the value of the property. In this case, we're using the appraised value. And then we subtract the loan amount. That's going to tell us how much the buyer has to put down. So that's the $14,450 down payment amount as it sits right here. Are we done yet, though? There's another step. And I would guess if you're looking at a multiple choice question on the exam, this $14,450 amount is going to be one of the potential choices, and people will choose it because they did some math, got stressed out, and figured, I see this number there, that has to be correct, I'm done. And I call it the panic onto the next math question answer, because they just want to be done with it and move forward. In this case, there's this other step. Remember that the appraisal price was lower than the sale price, and the buyer is going to have to come up with the difference. So we're going to take the actual sale price minus the appraised value, and we get a $1,250 difference between those prices. These are the three options I mentioned in the beginning. Buyer can get out based on the contingency of not being able to get financing. They can ask the seller to reduce the price. Or, what our answer uses, the buyer can pay the difference in cash. So we've got to take that $12,000, or we've got to take that $1,250 and add it to that $14,450 that's already required, that he already has. We add those two together, and that tells us how much money needs to be put down, $15,700.